Hello and welcome to Market Domination Overtime. Stocks closing the day lower here after a busy week on Wall Street. Our very own Jared Blickery standing by with the latest market action. Jared.
Busy week. What an understatement. Let's go over the closing numbers here. Pretty red down the line, but I'm going to show you the weeklies as well. Here's the Dow. It's down 177 points or 1/3%. And here's the let me put that. There we go. The 5-day price action down about 0.4%. So it wasn't terrible by any stretch, but it was just very volatile and rocky, especially in some individual names with those Mag 7 earnings. We'll get to some of them in a second. NASDAQ Composite finishing the week down a whopping 17 basis points, so not that far from break even. And here's the S&P 500, actually in the green by 1/3%. And Josh, you and I are going to be going over those monthly numbers in about 30 minutes. And let's do the small caps as well. They were the worst off, down about 1.6%. And I want to show you a few other markets. Here are the micro caps. Those were really surging earlier in January, but they kind of fell off this week, down 2.7%. Here's the Mag 7. After all the earnings said and done that we had so far, up almost 1 percentage point. And let's get to the Dow Transports. They finished the week up about 0.5%, although just about everything I just went over was down for the day. And checking in on the sector action, it was about staples and energy today, each of those up more than 1%. Tech had the worst showing. And here's the 5-day look. You can see healthcare down about 1.7%, but energy up 3.8%, followed by communication services. That's a meta story. So let's get to the NASDAQ 100 and show you what happened this week. Microsoft, a big standout to the downside, down about 7.7%. Tesla down 4%. But Meta, that powered that communication services run. By the way, that was another record high, 2 in a row here for communication services. Meta up 9%, Apple up 5%, and Alphabet up 3%. Back to you, Josh.
All right, Jared, thank you. Well, retail investor sentiment shows bullishness holding steady into 2026. That's according to Morgan Stanley Wealth Management. But with changing Fed dynamics and economic uncertainty persisting, we're exploring what this means for the retail trading landscape. Stocktwits head of markets and retail investor insights, Tom Bruni, join us to discuss. Tom, it is great to see you, as always. Let's start with the news of today, Tom. So we got this new wild card, right? President Trump says, Kevin Warsh, that's my guy. That's who I want running the Fed. What do retail investors say about that? What was the chatter on Stocktwits like?
Yeah, a lot of confusion, I think.
Confusion.
Yeah, ultimately, Kevin Warsh is seen as a bit of a hawk in terms of his demeanor and how he approaches monetary policy. And then you've got Trump, who's basically saying, whoever I pick next is going to lower rates.
Although Warsh now seems to have shifted a bit there.
Yeah, so it's an incremental change. I think the market is responding due to some of the extremes we saw in the dollar index, silver, gold. We're seeing mean reversion happen there because of this new information. But overall, there's still a lot of uncertainty. There's still time until May when Powell's ultimately out. So a lot of things are going to come out and change between now and then. So we'll see. But right now, the market is viewing this as a bit more hawkish than expected.
How do retail investors, do you think, how do they sort of broadly think about the Fed? Like, do you have line of sight there how fans on Stocktwits feel? Do they trust the Fed?
Yeah, it's a bit of a hard thing to quantify, right? But ultimately they care about interest rates because if you're investing in high growth areas like retail is, lower rates help those areas, higher rates hurt them. And so they're really looking for clear communication, clear guidance. And I think there's been this underlying feeling that maybe Powell and the Fed have been a bit behind the curve on inflation, hiking rates too late, maybe being a bit too, hesitant to cut rates. So there's a sense that the Fed is incredibly important, but sometimes they don't communicate as well as retail would like.
Let's switch gears. Let's talk about what Stocktwits fans are trading right now. You mentioned the metals.
Yeah.
I mean, gold and silver, of course, we've taught blistering runs, but today getting whacked. Which metals interested them?
Yeah, silver has been trending, the run in metals started most of last year, right? Gold was up 100%, gold miners up 130, 150%.
Just so it was parabolic moves.
It was broad-based, but it wasn't really until December, mid-December, that we saw, retail and public participation really start to escalate. You saw TV commercials about gold. I was getting texts about gold from friends. So we saw that escalate, and as you see with kind of the financialization of markets, for context, the SLV ETF traded $40 billion worth of shares today. That's like one of the most highly traded assets on the market. In terms of the number of physical gold being traded in any given day, Monday and Tuesday, we saw in the futures market, the amount of notional, tons of silver being traded was 2 years worth of production in the mine. So we're seeing a disconnect between the speculation side of things and the actual physical side of things, which I think is kind of correcting right now as we see this leverage start to come out of the system a bit.
Now, just to bring it back to what we began talking about, Warsh, there's this storyline today in the markets. Okay, Trump nominates Warsh. As you point out, Warsh historically we think is hawkish, right?
Yeah.
Concerned about inflation. That helps explain this whack that's going on with gold and silver. What do you think of that?
Absolutely. I think it's, the conditions were set, and this was kind of the match that got it going. Anytime you have silver went from $40 last year to 120, and a lot of that move happened in the last month or so. So anytime you get that level of aggressiveness to the upside, it doesn't take a whole lot to get sellers to really take control again. And I think that's what we're seeing. I think the overall consensus, though, among metals investors is the longer-term thesis remains intact, but we got a little silly here in the short term, and they're looking for prices to stabilize and then ultimately get back in for the broader theme of inflation reaccelerating.
So you mentioned the metals. What about Zoom and health insurers? Why are those on the Stocktwits radar?
Yeah, it's been interesting. Software stocks have been absolutely killed. I'm sure Jared and your team here at Yahoo has covered that in depth, but the AI trade against software has knocked a lot of big names, Adobe, Salesforce, Trade Desk. These names are retail favorites down 50, 60, 70%. And yet we're starting to see Zoom, which was a pandemic or a darling, hasn't really participated in this tech rally over the last couple of years. It's starting to break out. It hit its highest level since August 2022 this week. And the overall catalyst there was, funnily enough, an investment that it made in Anthropic. So Anthropic is raising money at a $350 billion valuation. Zoom had made an investment back in its Series C at a way lower valuation. And so they're sitting on this asset that analysts estimate is worth $2 to $4 billion. Zoom only has a market cap of about 25 billion. So that put it back on people's radars, combine that with improving technicals, and you've got a pretty interesting setup heading into 2026.
Can I also ask you about GameStop before I let you go? Because you point out, listen, we're at the 5-year mark here, the anniversary of the GameStop moment. You follow that closely, Tom. Over those 5 years, I'm just curious, for retail investors, what broadly has changed? What stayed the same?
Yeah, in terms of what's changed, I think Wall Street and companies' attitudes towards retail investors have changed significantly. Retail is here to stay. They now make up 20 to 25% of the average trading volume on any given day.
And you point out companies actively recruit those retail investors.
Yeah, they're courting them, right?
Yeah.
If you want a diversified shareholder base and you're not engaging with retail at this point, you're missing a massive opportunity, which is why Stocktwits sits in the center of this ecosystem. It's a critical platform for companies, CEOs, executives to be able to reach out to shareholders, understand what their concerns are, get their message out there, and really engage with them to create a strong shareholder base.
Tom, always great to see you. Thanks
for having me. Appreciate it.
Coming up, how could Trump's pick for Fed chair, Kevin Warsh, impact the housing market? We zero in on that next on Market Domination Overtime. Trump has made his long-awaited Fed pick, nominating Kevin Warsh to be the next Fed chair. We're diving into what this means for housing as the affordability crisis becomes a growing political focus. Yahoo Finance Claire Boston joins us now with more. Claire.
Hi, Josh. So President Trump has been laser focused on affordability, and he thinks that a key part of helping improve the housing market is to bring mortgage rates down. And he wants the Fed to help do that by lowering rates on the short term. And Warsh has not said a lot about the housing market and short rates, but one thing he did say is that he does think that the Fed can play a role here by lowering short-term rates, and that would flow through to mortgage rates.
So how can trying to influence mortgage rates, though, with monetary policy, how could that, Claire, potentially backfire?
Yeah, so one thing that's important to know about just this market generally is the Fed does not directly control mortgage rates. They control that short-term Fed funds rate. And so what can sometimes happen in a market like this, where we have some real inflation, if the Fed lowers rates too much, that can counterintuitively cause long-term rates to rise. And that's because investors are still worried about inflation. And mortgage rates are a long-term rate. So we can get in this weird environment where you lower short-term rates, but long-term rates rise, and that ends up hurting people who are trying to buy homes.
How does the Fed, Claire, broadly sort of view and think about housing affordability? And would that change if Warsh, yes, gets the official nod?
Yeah, that's a good question. So we are seeing right now a market where the Fed doesn't feel like they can really control housing affordability. Jerome Powell has repeatedly said that he thinks it's mostly a supply problem. Supply has nothing to do with what the Fed does. You know, he says that the Fed can sort of influence demand through this indirect rate connection, but he's been dodging questions about this. And so one thing that we'll have to see is that as housing affordability becomes a lot more politicized, is this something that Warsh takes a bigger role in? Is it something that he's really going to directly try to connect to what he's doing on the short-term rate side with the rest of the FOMC?
How have yields reacted to the Warsh headlines?
Yeah, it's been quite interesting. When last night it was rumored he was going to get the job, we saw 10-year Treasury yields spike about 4.5 basis points. And then things kind of calmed down. Today they're up about 2 basis points to 4.25%. That's a pretty minor move. And we've been talking a lot about how Warsh is generally a consensus, unsurprising pick. So I think that Wall Street is sort of in wait and see mode here, and we'll hear more.
All right, we will. Claire, thank you. Appreciate it.
Thank you.
President Trump taking aim at big institutional investors buying up single-family homes, but carving out an exemption for one fast-growing corner of the housing market. That would be build to rent. That's the model where developers build single-family homes specifically to rent rather than sell, adding supply without competing directly with first-time buyers. For more, we're bringing in now Bruce McNeilage. He is co-founder and CEO of Kinloch Partners. Bruce, it is great to see you. So let's dive into this, Bruce. So President Trump, he's got these big institutional investors in his sights, Bruce. Made it clear he does not want them buying up those single-family homes. But in this EO, this the executive order, he exempts your sector, Bruce, the build-to-rent sector. What do you think explains that carve out, Bruce, one? And two, I mean, you saw it. What did you think? What could it mean for the sector, the industry long term?
Well, our business has been booming for a number of years, Josh. And what it's going to do and what we do is we add supply to the market. We don't take houses out of the market. We're creating new houses. So what that does is it puts stock out there. People have a choice for the first time in many years to rent a brand new house, and it's not taking houses off the MLS, it's creating new housing, and actually that's helping people buy existing houses because, again, we're creating new houses.
The executive order, Bruce, it does mention, talking about this carve-out, narrowly tailored exceptions. And any line of sight there, what could be some possible exceptions, Bruce, some gray areas?
Well, what is a investor? What is a large investor? I've seen where they're going to consider an investor that owns 10 houses or more Wall Street or a large investor. If that's the case, Josh, my grandparents were Wall Street, right? They owned over 10 rental houses. So I'm concerned that they're going to go really deep into this and go after small investors. And there's 86 million rental houses in America, and only 4% of them are owned by institutions. So I think what he's doing is he's looking at something in the wrong light. But again, build-to-rent operators are going to profit from this, and it's going to continue to make our sector boom.
So you work in this interest rate sensitive sector, Bruce. You're tracking all things Fed, I would imagine. What did you make of this news today that Trump, listen, he's made Kevin Warsh, that's his guy. That's who he wants running the Fed. What do you think, Bruce? Good pick?
Yeah, I think it is, but does it really matter who the pick is? Because we're looking at a couple things. Josh, right now, right now today, interest on credit cards is 24%. Do you know want to you look at what makes houses unaffordable? When you're paying 24% on credit cards, or when you're paying 6 or 7% on mortgage rates. That's what's making housing out of reach for most Americans. So yeah, I think it's a great pick, but if he picks someone else, would it really make a difference in housing supply and the price of mortgage rates?
Let me ask you this, Bruce. How big is the build to rent sector now? I asked because the Journal had some good stats on this. They said over 320,000 built to rent homes built since 2012. And most of that is coming in just the last 5 years. So how big is the sector, Bruce? And how fast will it grow from here, do you think?
Yeah, so it's growing very fast. People like the idea of renting a brand new house. I mean, what's better to rent than a brand new house? They stay longer, they get ingrained in the community, and it really benefits the community by bringing new business and new people to the communities. Business is going to continue to boom. There's going to be tens of thousands of more houses built every year in the build to rent sector. And most of this is done in the Smile States, the Southeast, Texas, and Southwest. But we're starting to see build to rent in places like Indianapolis and other cities throughout the country. This is not something that is just regionally located. It's now moving across the country, and it's just a great thing for people that now have a chance to choose another asset, another way to rent a house or rent a property. And it's much better than an apartment complex and some other opportunities and some other choices that people have.
You said something there, Bruce, I just want to pull on for a second. As a homeowner myself, I am very interested in what's going on in my community, right? Like I want to know what's going on with the community, with the local schools for my kid. And I'm involved to that point, Bruce, because I'm not going anywhere for a long time, right? We're there, we put down roots. And I'm just curious, do you think that is the same with people who are opting for a built to rent model?
Josh, it is. The average person stays in an apartment roughly 2 years. The average folks that stay in a build-to-rent house is between 4 and 5 years. So you actually have people that stay longer, that get more ingrained in the community. They do business with businesses in the community. And yeah, you're seeing a lot of people stay longer. And when they stay longer, they usually will buy a house when they're ready. If they're ready, if they want to, in that same community. So it does have a spillover effect where it's helping people buy houses when they're ready to rent. This is really a hybrid, Josh. It's the difference between when you look at an apartment complex or owning a home, we're right in the middle. We're right in the middle. And so this is a stepping stone for a lot of people before home ownership.
Who is your customer, Bruce? I'm curious. What's the average demo? Can you give me some line of sight there? And has that shifted? Like, is it different than if I'd asked you, Bruce, a year ago or 3 years ago?
When I got in the business, people rented out a necessity. Now many people rent out a choice. Our average tenant makes $126,000 a year. They have a credit score in the mid 600s, and they're college educated in their 30s. These are people that could buy houses or could buy houses in the future. They just choose not to. Maybe they're new to a city. Maybe they just got married. Maybe they have some debt they want to pay off. But our average tenant makes over $100,000 a year, and they have good credit scores.
What about the built to rent model, Bruce? I'm curious, is attracted to investors? Like, walk me through it. Is it cost? Is it the scale? Help me understand.
Yeah, I think for build-to-rent investors like ourselves, corporations like ourselves, it's a consistent stream of long-term income for a real estate outfit, for an investment firm, and it's not something that has cycles like an apartment complex community, other multifamily. People are sticky. Josh, it's important to point out the industry is 97% leased. Our homes on average in the build-to-rent business across America are 97% leased. Why is that? Because people need a home and they want a new home. And our company and other companies like us are providing brand new houses at an affordable rate to people across America. And they vote with their pocketbook. They're staying 4 to 5 years. And again, they have a brand new house in a community with good schools, parks and recreation. And what better, again, if you're not going to own a house than renting a brand new house?
Finally, Bruce, just, listen, I want to ask this question. And it's a blunt question, but it's a question that's raised, Bruce. Is home ownership, as part of what we traditionally thought of as, the American dream, is that dead, Bruce?
It's not dead, but it's shifting. It used to be, you bought a house, you saved in a pension plan, you retired, you moved to Florida, and you lived the American dream. Now things are shifting. People want more experiences. Maybe they saw their parents lose houses to short sales or foreclosures. So what we see is people want to rent. They want to be flexible. They want the lock and leave lifestyle, where in a year they can lock up, give us the keys and leave and move. They don't want to be burdened by home ownership that, quite frankly, a home goes down in value as much as it can go up in value. They don't want to write a check to get out of the house. They love the lock and leave lifestyle, and that's what Build to Rent can afford them and offer them. And our business is growing around the country, and I would ask Donald Trump not to mess with our business. We are providing something that is very, very much in need of, and we're supplying stock, housing stock, to America. We're not taking away from it, Josh.
Bruce, as always, great to have you on the show. Thank you. Time now for What to Watch. It's going to be a busy earnings stretch ahead with big tech firmly in focus. We're also going to hear from major pharma companies, including Merck, Eli Lilly, and Novo Nordisk. But all eyes are on the Magnificent Seven. Analysts are watching Amazon on Thursday for signs that AWS growth is accelerating again, driven by rising demand for AI tools and infrastructure. We're also hearing from Google parent Alphabet on Wednesday. Investors are looking at whether Gemini traction can continue to support search and YouTube growth, while cloud demand tied to AI inference remains a key driver. In semiconductors, AMD reported results on Tuesday, with analysts expecting CPUs to lead near-term results. In the media space, Disney posted earnings on Monday as investors look past a mixed quarter and toward fiscal 2026, with parks performance, streaming profitability, and CEO succession front and center. Speaking of entertainment, we'll also be listening close to the Senate hearing next week on the proposed deal between Netflix and Warner Brothers Discovery, a development that could have major implications for consolidation across Hollywood. And finally, the January jobs report that's coming out on Friday to end the week. Economists forecast the U.S. economy to add 65,000 jobs, while unemployment and hourly wages hold at 4.4% and 0.3% respectively on a month-over-month basis. That's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after closing bell. But don't go anywhere. On the other side of the break, it's asking for a trend, and I've got you covered for the next half hour with the latest and greatest market-moving stories. Stay tuned.